Welcome back to the BD Daily Finance News Podcast for 2025-11-25. We've got a packed 10 minutes today. Nvidia under pressure from a Google Meta chip twist, markets betting hard on Fed rate cuts, Bitcoin staring down a huge options expiry, and some big moves in gold and copper.
Stick around if you care about where the next leg of the AI trade goes, how to position for a potential December cut, and what record metals premiums are telling us about the real economy. As always, this is for information only, not investment advice, so use it as a starting point for your own research.
Let's start with the AI chip drama. Nvidia shares dropped after reports that Meta is in talks to spend billions of dollars on Google's custom AI chips, and one headline had Nvidia off roughly 3% intraday on the news. The idea is that Meta may diversify away from Nvidia's H100 and B100 accelerators and lean more on Alphabet's in-house silicon in its data centers.
That's a big deal because Nvidia has dominated AI accelerators, at times controlling well over 70% of that market by revenue. A separate piece noted Alphabet stock actually rose on the possibility of a Meta chip deal, framing it as a new twist in the AI trade, where hyperscalers increasingly design or adopt custom chips to claw back costs and reduce reliance on Nvidia.
There's also a sentiment angle. Another article pointed out that Nvidia is pushing back against comparisons to Enron and even to the late 90s dot-com bubble, while Michael Burry is drawing his own parallels. When you see single stock narratives get that heated, with one of the world's most valuable companies moving several percent on a single chip customer rumor, it tells you how crowded the trade has become.
For investors, the key takeaway is concentration risk. If one or two mega customers can shift billions in capex to a rival like Google, Nvidia's growth path becomes more volatile, even if AI demand overall keeps rising. On the flip side, Alphabet potentially gets a second revenue stream from selling or leasing chips to third parties, not just using them internally, which could support its multiple if it executes.
And this is all happening while another booming tech stock is being added to the S&P 500, underscoring how AI and chips are driving index composition. If you own broad market ETFs, you're indirectly exposed to this AI arms race, whether you like it or not. Let's pivot from chips to the macro backdrop that's shaping valuations.
Exactly, because the AI story trades very differently in a high-rate world versus a cutting cycle world. So let's talk about those surging rate cut bets and what they're doing to global markets and the dollar.
One of the higher scoring pieces today says rate cut bets have surged, with markets today seeing global stocks rise on expectations the Fed will ease. Another note on the Thanksgiving week rebound cited New York Fed President John Williams hinting a cut in the near term could still be appropriate, pushing implied odds of a December cut back toward roughly 70% on some trackers.
We're also seeing that in futures. One wrap mentioned U.S. stock futures dipping slightly after a tech-fueled S&P 500 rally as traders wait for data to see if that optimism can hold. Asian shares posted modest gains, European stocks were more subdued, and gold caught a bid as the Fed tone turned more dovish. It's very much a data-dependent rally, but you can feel the market wanting to front-run cuts.
There was also a piece arguing that big federal deficits are actually bullish for stocks in the short term, even though they raise longer-term risks. Combine that with potential cuts, and you get this risk-on flavor. Tech up, cyclicals catching a bid, and volatility compressing. But we've seen before that when everyone piles into the same macro trade, even a small data miss can unwind it fast.
For listeners, the practical move is to know what's actually in your portfolio that's sensitive to the front end of the curve. High-duration growth stocks, long-dated bonds, and even some REITs. If December doesn't deliver a cut, or if the Fed signals fewer cuts for 2026, those could be the first to re-rate. keep an eye on upcoming U.S. retail sales and inflation prints because they're the swing factors for this whole narrative.
And tying back to AI, a lower rate environment tends to support those long cash flow stories like Nvidia and Alphabet, which is why macro and micro are so intertwined here. But crypto is also trading those same rate expectations in a very different way, especially around options.
Right, and nowhere is that more obvious than in Bitcoin's options market this month, which brings us to our next segment.
One crypto headline today highlights that Bitcoin is facing a massive $13.3 billion monthly options expiry, with spot BTC trading well below the max pain level for option holders. Max pain is basically the price where the largest number of options expire worthless. So when spot drifts away from it, you can get hedging flows that amplify volatility.
Another Asia morning briefing notes that Bitcoin has steadied, while prediction markets on Polymarket are leaning toward a December Fed rate cut. So you've got derivatives on top of derivatives, options expiring in the tens of billions, and traders in Asia effectively betting on the Fed via crypto sentiment. That's part of why November is shaping up as one of Bitcoin's more volatile months since 2022.
The spillover is visible in traditional products too. One headline points out that BlackRock's iShares Spot Bitcoin ETF has seen about $2.2 billion in outflows so far in November as prices cratered, making it crypto's worst month since 2022 by some measures. That's a reminder that even regulated wrappers don't insulate you from underlying volatility. They just change the access point.
If you're trading or investing around this options expiry, position sizing is everything. The combination of large notional open interest and macro catalysts, like the Fed Beige Book and U.S. data, means intraday swings of 5% to 10% in BTC aren't unusual. Long-term holders might simply ride it out, but shorter-term traders should know their liquidation levels and avoid overusing leverage.
And for people who don't touch crypto, it still matters because stress there can bleed into broader risk sentiment, especially when it coincides with tech and high-yield risk-on trades. Let's move from digital assets to the old-school store of value, gold, and how policy shifts in China are hitting the physical market.
Exactly, because the gold story today isn't just about prices. It's about taxes and demand in one of the world's biggest consumer markets.
One standout article reports that Chow Tai Fook Jewelry Group missed estimates, with slightly weaker than expected profits amid broader economic headwinds. Investors are especially worried about the longer-term outlook after China removed a long-standing tax rebate on gold, which had effectively subsidized parts of the jewelry value chain.
That change matters because China is one of the world's largest consumers of physical gold, and Chow Tai Fook is a bellwether for middle-class jewelry demand. If margins get squeezed and consumers pull back on discretionary purchases, it can dampen retail gold demand, even if global investors are buying ETFs on macro fears. It's a reminder that gold is both a financial and a consumer good.
At the same time, another commodity headline shows a very different story in copper. Chilean giant Codelco is reportedly offering record premiums for 2026 refined copper sales to Chinese customers, signaling concern that a rush of metal into the U.S. could leave the rest of the world short. That's the opposite of a demand slump. It's about tight supply and regional competition.
Higher copper premiums to China suggest smelters and fabricators are willing to pay up to secure units, which fits with the long-term electrification and EV narrative. For investors, it means you can't treat all metals the same. Gold is being reshaped by tax policy and consumer demand, while copper is being driven by structural supply constraints and green investment trends. It's a classic case of why sector-level commodity ETFs can mask very different underlying stories.
Nvidia's wobble as Meta kicks the tires on Google's AI chips, surging Fed rate cut bets lifting risk assets, Bitcoin's $13.3 billion options overhang, and how China is simultaneously dampening gold demand while bidding up copper via Codelco's record premiums. All of it points to a market that's still very much driven by policy choices and a handful of big tech and commodity narratives.
If you found this useful, hit follow, share the episode with a friend who's watching AI or crypto, and consider reviewing your portfolio's exposure to these themes before year-end. We'll be back tomorrow with more on rates, earnings, and anything else markets throw at us. Thanks for listening to the BD Daily Finance News Podcast.